1929, in response to a contracting economy and investor panic, the stock market plummeted, signaling the start of the Great Depression. It took more than 2 decades for the market to recover, after bottoming out in 1932, more than 80% below peak prices. 2000, the dot-com bubble burst in March 2000, following a surge of investment and speculation in internet-related ventures in the 1990s. The S&P 500 lost nearly half of its value and took 7 years to recover. In the year 2020, as COVID-19 spread around the world in February 2020, the stock market dropped by more than 30% in just over a month. The market, however, had already recovered by August 2020, taking 6 months to do so. The market is still expected to crash, according to big-name investors and analysts.
There are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen.
It's crossed off all the boxes. It's done all the things that a super bubble typically does, and it could start its way down anytime.
Even though the stock market has its ups and downs, the reality is that stock market crashes are uncommon, and no one can predict when they will occur.
Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is gonna go up, down, sideways, or in fucking circles.
However, even though market downturns are uncommon, as investors we must plan for and prepare for them. First and foremost, don't panic. Many investors' emotions often take over during a market crash. It's difficult not to panic when I see large unrealized losses in stocks I own. This can often lead to an increase in selling activity, driving prices to irrational lows. Warren Buffett once said, "The sillier the market's behavior, the greater the opportunity for the businesslike investor." During these times of extreme uncertainty, it's clear that Buffett remains calm. He conducts himself in a businesslike manner, effectively removing emotion from the picture. It serves as a reminder to me to keep my cool. It's also a reminder to turn the negative into a positive by viewing a market crash as an opportunity to buy low-cost stocks.
Some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks.
Secondly, be patient. A wise man once said, "No matter how great the talent or efforts, some things just take time." You can't produce a baby in 1 month by getting 9 women pregnant. During a market downturn, I may have to wait several months for the market to recover. The FTSE 100, for example, has only recently risen above levels seen before the pandemic. Some things simply take time to accomplish. So, in the event of a market crash, I'll have to temper my expectations about how long I'll need to hold some stocks that are losing money for me. If I have a portion of my portfolio allocated to top dividend stocks, this will help me. Even if the stock price is declining, I can still profit from dividend payments during this period. I believe this is an excellent tool to include in my overall stock portfolio.
What would be the first thing that you would want people to know about this market?
Well, in the famous words of Warren Buffett, who is considered the greatest investor of all time, he would say that the stock market is a device, it's a vehicle that transfers wealth from the impatient to the patient investor. So in times like this, when it's you want to run for cover because the market's become more volatile, to just maintain the course and continue investing on a monthly or weekly basis is something that still is a very important thing to do.
So just be patient.
If you are a long-term investor, do nothing. Let the market crash. A long-term investor has less to worry about the stock market situation, as it doesn't impact them with major hits. The reason for this is simple: the stock market's volatility. If the market is on its knees today, in the coming few days, it will be up in the sky again. It is best to do nothing as a long-term investor, as the wave continues to flow with both upward and downward thresholds. Additionally, it is an open window to buy more stocks for long-term investment, as the prices are on the downward threshold. This way, you can book more profit for the future by spending only a little during these times. This is a perfect opportunity to invest in long-term stocks as right when the market has hit the rock bottom. The reason for this is simple. Long-term stocks that last for over 10 to 25 years yield more profit because of the indirect impact of deflation and high profit margins. You must be wondering how deflation can be one of the reasons for higher profits. The reason is what you invest today will hold lesser value in the coming 10, 12, 15 years because of the deflation, and that time, the investment may be considered minimal, but the profits will be much more in numbers.
So deflation, everything being equal, and it isn't equal, is good for investors because the value of money appreciates, the buying power of money appreciates.
Despite the fact that stock market returns can be quite volatile in the short term, research shows that stocks outperform almost every other asset class in the long run. Even the biggest drops appear to be mere blips in the market's long-term upward trend when viewed over a sufficiently long period of time. This is especially important to remember during volatile periods when the market is on the decline. With a long-term perspective, you'll be able to see a big market drop as an opportunity to build wealth by adding to your holdings rather than a threat to wipe out your hard-earned savings. During major bear markets, investors sell stocks regardless of quality, creating an opportunity to buy select blue chips at attractive prices and valuations. Consider dollar cost averaging if you're concerned that this strategy might be construed as market timing. Dollar cost averaging is a method of averaging out the cost of owning a specific investment or asset, such as an index ETF, by purchasing the same dollar amount of the investment at regular intervals. The end result may be a lower average cost for the investment because these periodic purchases will be made systematically as the asset's price fluctuates over time. Knowing what to do when stocks go down is crucial because a market crash can be mentally and financially devastating, particularly for the inexperienced investor. Panic selling when the stock market is going down can hurt your portfolio instead of helping it. There are many reasons why it's better for investors to not sell into a bear market and stay in for the long term.
If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down.
We understand stock market crashes are disheartening, but to make a wise decision is all it takes along with patience. If you can, buy more stocks after the crash and look into investing in long-term stocks. The stock market is volatile. If it is rock bottom today, it will also rise in the near future. We would like to emphasize that when the markets crash, do not panic. With that said, thank you for watching. Please remember to hit the subscribe button and share the video.